This opinion piece is brought to you by the Financial Times and read out by naturalreaders.com. Slight revisions were made to the actual text for your listening pleasure. No copyright infringement intended. Politics trumps money in Chinese markets. Why China's market crackdown could last far longer than most people think. Written by Shanghai-based independent economist Andy Siat. First published on the Financial Times on the 21st of September 2021 at 11:01 p.m. London time. Some investors assume that China has a clear endgame in mind, that China already knows how its current interventions in the private sector would ultimately end. Such investor assumption is likely to be wrong. In the case of troubled property developer Evergrande, Beijing is clearly seeking to cool an over-indebted sector and inject greater discipline with stricter rules on borrowing. Taking a broader view of recent events, the Evergrande meltdown together with the crackdown on tech and education sectors, Beijing is actually seeking to rein in capitalism itself. How far that goes remains to be seen. Let's take the tech sector for example. Even Beijing may not know whether it will be comfortable with big tech in the future and in what form. Chances are the Chinese Communist Party will keep a wary eye on internet-based businesses for years to come. On the surface, the government complains that big internet companies are monopolies and accuse them of abusing their market power for profit. To be sure, both points are true. Ending exclusive content arrangements, for example, is one way for the government to rein in the market power of the existing players. But will this be effective? Google's search engine is dominant despite the absence of exclusive arrangement in place. Businesses driven by big data are self-reinforcing, and the successful ones tend to enjoy monopoly-like market shares. If market share were truly the issue, the government would have to do a lot more if only to curb the excesses of dominant market players. Upon closer analysis, however, the monopoly problem is unlikely to be the main reason for the crackdown. After all, it was the Chinese government who helped them grow into monopolies in the first place back in the day. Over the past decade, Beijing tried to replicate successful US internet companies so that Chinese users need not envy and pine for American online experience. The enormous payoffs for early investors in Tencent and Alibaba have enticed huge amounts of risk capital pouring into China's internet sector. But the trade tensions between the US and China showed the government what is really important, that China needs advanced chips in order to stay ahead. In contrast, internet companies merely make existing goods and services easier and more convenient to acquire. The CCP could easily tolerate a little more inconvenience for the people in pursuit of a broader aim or a greater objective. Hence, the government now wants to have the final say over capital allocation. Perhaps the biggest threat to Beijing is that big internet companies may weaken one-party rule over time. The CCP has been on a multi-year campaign to secure its reign for another century. To achieve this, it needs popular legitimacy, but it is competing against the internet companies for the attention of the masses, and this has got to worry Beijing. This worries Beijing even as it relies on big tech for many things. This worries Beijing even as it uses Alipay and WeChat to reach the populace with its health code system introduced during the COVID-19 pandemic. This health code system assigns a health status to citizens, indicating whether they can travel freely or not. The only way for the CCP to shore up its position is to cut off the competition. Back in the day, the party used to have a complete grip on the economy and populace during the Cultural Revolution. How much of a total grip? How much control is enough? How much control does the party need if only to make itself feel secure? How much control would it take to make the party happy this time around is anyone's guess. This is why the crackdown on big tech could last for a long time. Some may question how the economy could manage to remain robust when risk capital and private businesses have one hand tied behind their backs. If anything, if the past 5 years is anything to go by, the Chinese economy has clearly shown that it can take a lot of pressure and still keep humming along. China's exports are likely to reach $3.5 trillion this year. That's a whopping $1 trillion more than when the trade war began in 2018. The secret sauce in the thick of it all is the undervalued exchange rate, just like it had been for other East Asian economies in the past. China's infrastructure and mass education have already reached or even surpassed OECD levels. but per capita income at the official exchange rate is only 30% of gross domestic product. The Chinese currency is undervalued by at least 1/3. Now, get this. An East Asian Mandarin state can channel excessive monetary growth from an undervalued exchange rate into capital formation, thereby turning inflationary pressure into export expansion. Let's back up a little and play that one more time. An East Asian Mandarin state can channel excessive monetary growth from an undervalued exchange rate into capital formation, thereby turning inflationary pressure into export expansion. This powerful tailwind can keep China going for as long as the West, especially the US, keeps stimulating consumption. Modern China has gone through rounds of revolution, reform, and restoration. The CCP did 3 decades of revolution, 4 decades of reform, and is now embracing restoration. Its main objective is to meld a high-tech modern market economy with a traditional Chinese top-down power structure. And all things under heaven, anything and everything under heaven, be it money or fame or business, cannot be allowed to challenge this prevailing order. This opinion piece is brought to you by the Financial Times and read out by naturalreaders.com. Slight revisions were made to the actual text for your listening pleasure. No copyright infringement intended.